again, Reppond. Welcome to my YouTube broadcast. Today is June 19th, 2024. Yesterday I gave a piece from my friend, Brian Schreiner. Brian writes a blog. I read it every week, and he says that he listens to my podcast every week. So we enjoy sharing information back and forth. In last week's blog that he wrote, he had some interesting data, and I'll read it to you, and I'm going to give you my takeaway. And it is about the economy and people's perception of the economy that people live in, their reality versus what the data says. It's very interesting. But we all live in our own reality. And if that's different from the reality, then it's our own perception. So he said this: the change in sentiment on Wall Street is something the average American has been feeling for some time. Sounds like years. According to a poll conducted by The Guardian newspaper, 55% of Americans believe the economy is shrinking, and 56% think the U.S. is experiencing a recession, even though the economy, GDP, has been growing. 49% believe the S&P 500 index is down for the year, but it's actually up more than 12% year to date. 49% believe that unemployment is at a 50-year high, but it is actually at a 50-year low. Isn't it interesting how the perception of our reality is different than what the data says? Okay, I want to go into the dashboards, and this will be as of last Friday, June 14th. So it gives us about half a month of data. In the yellow box, you will see listed from top to bottom how the major indexes did for the last week. So you can see that some of them are in green, which means they were positive. Some are in pink, which is negative. They did poorly. So very interesting to see the difference. What did really well was the NASDAQ 100 and the Treasuries for a change. And that helped out traditional portfolios. What did really negatively was developed markets, EFA, mostly Europe and Japan, did really poorly. And the others are somewhere in between. When you go over to the pink box, you can see that the two that did really well were the S&P 500 and the NASDAQ. And then, some of them did well, but not amazing. The Russell 2000 is actually negative for the year by about 1%. But the Treasury, even though it did well, the long-term Treasury bond ETF, it did well for the week, is still down over 4% for the year to date. There are potentially 28 dots, green dots or red dots, over to the right. And 18 of those were green compared to 21 out of 28 for the previous week. When we look at the sectors within the S&P 500, again, the yellow box refers to last week, and the pink box refers year to date. So the tech sector up over 5% for the week. Energy sector down over 2%. And the telecommunications sector, which has been struggling, is down over 2%. Year to date, the tech sector is up over 18%. Next is financials. So it goes from 18 all the way down to 8. and then 6, and so forth. And then you have 3 sectors that are negative year to date, which are consumer discretionary, real estate, and telecommunications. So this is a 24-month chart, weekly chart. So one move equals one change in this line equals 1 week, and for a 24-month period of time. So I take it from the bottom, which was in October of 2022, to where it is today. And you can see the long-term picture is up, up, and up, and the short-term picture is over the last couple of months, and that's also up. And then another intermediate term from about November to present, so that would be about 7 months, and that's up. So whether it takes a breath and pulls back some or not, it basically is on the move up, and it's definitely at an all-time high. I break it down to a 9-month period from a 24 to a 9, and I also change this from a line chart to a candlestick chart. And the reason for the candlestick, it gives us a little more information because it shows that each week, now remember, each one of these candlesticks represent 1 week. So when it starts here, and then it is a kind of a blank candlestick and goes up, maybe it has a wick on it, maybe it doesn't, but that represents beginning here and finishing here, beginning here and finishing here. When it is filled in with red, that means it started here and went down for the week. So you can see those periods, a couple of them where it went down, but most of the time it went up. And it's for a 9-month period, that's a very interesting chart. It shows a lot of strength in the market. Then I get to relative strength. So I take, and this is a new chart, by the way, I put in the NASDAQ 100, which has done very well, and the S&P. And I did it on a relative strength. So if it goes up, that is favors the NASDAQ, it's a numerator. And if it goes down, it favors the S&P 500 SPY, and that's the denominator. So you can see from the beginning of 2023, the degree to which tech, NASDAQ 100, heavily weighted technology, has outperformed the broad market, the S&P 500. There's a period of time in the middle where it goes up and down and up and down, and that's a period of time where neither one is in favor. The NASDAQ wants to get in favor, and then it falls back, etc. But I just thought I'd show you that to show you the degree in that period of time, about a year and a half, that period of time, that the degree to which the NASDAQ 100 is outperforming the broad market. Then I flipped it around. I made the S&P 500 SPY, the numerator, and the NASDAQ 100 the denominator. It's the same chart, except it's kind of flipped on its head. So you can see the degree to which the S&P 500 has underperformed the NASDAQ, or you could say the degree to which the NASDAQ 100 has outperformed the S&P 500. Same thing, but there it is inverted. Now I'm going to go to a value growth chart. Inside the S&P 500 are 2 kinds of stocks. They're either value stocks or growth stocks. They fall into one category or the other. So if I put growth stocks, SPY-G, as a numerator and SPY-V, Victor, as the denominator. So if it goes up, it favors growth. If it goes down, it favors value. And there's some of both. You can see at the end that during the last couple of months how much, to look to the right of the chart, in the last couple of months, you can see the degree to which that this went up. I mean, it just skyrocketed because the value stocks are kind of doing nothing, and growth stocks are dominating the market. Matter of fact, they're holding up the market. Another interesting thing, and I've commented, I think, on this before, you got to get to the middle of the chart, and you see how the line goes down? We entered the market during that period of time. We'd been out of the market for about 6 weeks, but we entered the market the 1st of November, and the growth stocks were already going down. Value was in favor. We dodged, definitely some of that bullet in the downturn. But when we did enter the market, we entered into value stocks, the Dow, which is mostly value stocks. And we participated in that all the way to the beginning of 2024. And then we switched over and moved into growth stocks. So that's one of the mechanisms we use to manage risk, is growth or value. And this clearly shows that growth was out of favor during that period of time. And then more recently, in the last 2 or 3 months, it has big time been in favor. Then I compare the S&P 500 to the Russell 2000 small cap index. And so you got large companies and small companies. So when this goes up, it favors large companies. Whether they're value or growth, it favors large companies. And when it goes down, it favors small companies. And there are some of both. So you can see that, again, look to the far right of the chart, and you'll see that the S&P 500 large companies clearly way in favor over small companies during the last month or so. The long-term government bond ETF is TLT, and it has been in a longer-term trend, or certainly intermediate term, I think longer-term trend downward. It had a good week this last week, as I reported earlier, and you see that from the little tick up at the end, and that was positive for bonds. Why did that happen? It happened because interest rates and bond yields are going down, or are perceived to be going down in the near future. So if there is the anticipation of that, it will push the price of bonds up, but the yield on bonds down. And that's what you see at the end. But for the last, since 2020, you can see the degree to which bonds have lost a lot of value, and traditional 60-40 portfolios have suffered accordingly. So they do need some help. This last week, they got a little bit of help. The dollar continues to rise, rally almost, and you can see all the way back to 2021. So this gets us back about 3 years, and the dollar has been definitely in an upward move. Other currencies are weak by comparison, and we're the reserve currency, and so the strength of the dollar is helping us when we're buying things abroad or traveling abroad, and it hurts people from other countries who are buying things or traveling into the U.S. Gold, represented by the ETF GLD, continues to go up. It's a little rocky, so you can see that there are periods where it goes up and then periods where it goes down for a while. Most recently, it was up, so you can see that at the very far right of the chart, gold continuing to go up and, well above its 20-period moving average. Silver, represented by SLV, also had a positive week, a little tick up there at the end. Not as much as gold, so but they're both up. When we compare silver and gold, and we've done this for the last 2 or 3 weeks, gold has outperformed silver. So if it lost money, it lost less. If it made money, it made more. And that is from that tick down at the very end is why you see the outperformance by gold over silver. In the middle, you see a lot of this, a lot of up and down. Silver will come into favor, and then gold will come into favor. If it goes down, it favors gold, and vice versa. Bitcoin dropped this past week, is still above its 20-period moving average, and but it's on an intermediate term period from late 2022 to present. It's been on an upward trajectory. Volatility index, the VIX, VIX, had a move up. There was more volatility in the market this past week, so that's why you see that little move up at the very far right bottom of the chart. But over a couple of year period of time, you can see that the volatility index has definitely been moving down, which is good for equities, or that equities are actually the stability and the growth of equities is actually causing the volatility index to decline. And now it's down in the 12s, and that's pretty low. The Asbury Research puts out 6 indicators, technical indicators, and there were 3 positive last week. There are 3 positive this week, and of course 3 negative. They also put out a cross-asset relative performance chart comparing one asset to another, and I'll cover those that are solid green for the 3 time periods going from left to right, the last quarter, the last month, the last week. The broad market is stronger than the blue chips, which is the Dow. The tech market is stronger, the NASDAQ 100 is stronger than the broad market, the S&P, and growth is stronger than value. We saw that in earlier charts. U.S. is stronger than emerging markets and developed markets in all 3 time periods. Corporate bonds outperform government bonds, and long-term bonds outperform short-term bonds. Now this is interesting. So when you see these 3 time periods, the last quarter, the last month, the last week, look at it. The U.S. is outperforming from a market perspective, not from the economy or the currency, but just the equity market. Look how strong the U.S. is compared to all other markets except Taiwan and India. And they are doing better than the U.S. in all 3 time periods. But so that speaks for itself. Yesterday in my video, I showed a piece from Dr. Mark Faber, and who lives in Chiang Mai, Thailand. And he said, the market is terrible here in Thailand. And I think the dollar is very strong relative to the Thai currency, and the market and the economy and the stock market is doing much better in the U.S. versus Thailand. But look at that chart going from the beginning of 2023 to present. I can see why he made the statement he did. Okay, now gold and silver. As of last Friday, the spot price on gold was $2,336. Silver, $29.57. You need to put the markup, the commission, on top of this, and that varies a little bit from place to place. The gold-silver ratio based on spot is 79-1, and that favors silver as a better buy than gold, in my opinion. Gold was up 1.7% from the previous Friday, and silver up 1.3%. A monster box of silver is $15,975, almost $16,000. So this got down, I think I remember it being down in the 11,000, between 11 and 12,000 range sometime this past year. So it's definitely been moving up. The spot price is $22.38 over spot. So when you add that to the spot price, times 500 is where you get the $15,975. If you buy it in a tube of 20, it's $32.15 per round or per ounce. It was the best of times. It was the worst of times. Do you remember that? I remember it from high school. I remember it from Charles Dickens' A Tale of Two Cities, written in the mid-1800s about, set in the time period of Paris and London, set in the period of time from in um, pre-Revolutionary War, the French War, and what Dickens wrote about, if you read that, you would remember that what he wrote about was the aristocracy in London and Paris versus the common man, the commoner, and the stark contrast. We're not there today, but it made me think of A Tale of Two Cities and the stark contrast between the haves and the have-nots, or the uber wealthy, or even the wealthy, and those who are just working people who are not in that category. The gap, it seems to me, that gap is widening. And for societies in general, that's usually not a good thing. So, is that Charles Dickens or is it economic data? Some of both. Thank you for watching. If you have a question or comment, leave them in the comment section below.